Okay, guys, time to have a look at some CoreLogic data again. What's happening in the market for 2025? So, this has just come out this week, 23rd of January from CoreLogic. And if you are serious about investing in real estate, I definitely do suggest that you get onto subscriptions with these kinds of reports. That being said, I know for me early when I started on, I kind of saw them as the be all and end all. This is going to give me the recipe. This is going to give me all the information I need to make informed decisions. And that's just not the case. So they are a crucial part of the picture. You definitely want to invest in this kind of thing, but you also need to learn what it's missing and what the gaps are that you need to fill in and how to do that. So let's work our way through this one, and I'm going to point out a few of those things in this because this is really crucial and important information, but I'm going to help you see how it's not the entire picture, and that can make a big difference. So there's a few points. It's a fairly short report this month. Lower interest rates to boost housing values, transactions, but not by much. And basically what they're arguing there is that even though we might see some reductions in interest rates, the current affordable purchase value of properties based on cost of living after inflation, all those sorts of things, is quite low. So look, relevant point. That being said, there are still buyers in the market, and any reduction in interest rate is going to see an increase in borrowing capacity. Now, what does that mean? Is that going to bring more people into the market? Is that going to drive prices up? Well, historically speaking, and just the way free markets work, is if more money is available, prices go up. So if there is demand outstripping supply and more money is made available to the buyers, then that just means if you could previously bid to 800, now you're going, oh, I can go the bit higher. Maybe I can go to 850 now because I can borrow $50,000 more. So that's what tends to happen. So then we see that lift in prices. So while this year may not necessarily be a gangbuster year, there's some competing factors in the market. Any drop in interest rates is likely to see a bit of buoyancy there. Not to say that there aren't other factors that can outweigh that. And one of the things that they point out, which is also fair, lending policy could amplify or nullify the impact of rate reductions. So in a sense, interesting topic, kind of also a nothing paragraph because it suggests it could go either way, but it's true. So one of the things that's been talked about and thrown around for quite a while now is this buffer zone. The buffer in terms of borrowing capacity calculations. So at the moment, there's a 3 percentage point buffer zone required. So when they assess you for lending, if the interest rate is 5% that the bank is offering you, they actually need to test that you can afford 8%, which is a very significant difference. And that buffer didn't used to be that big. But their argument is that where there potentially still could be financial costs and financial surprises in the future. Well, of course there could be. But that is on the very high end of what the buffer zone, potentially the highest, I'm not sure, that the buffer has been in the past. So there are arguments and people pushing to have that buffer reduced again. If that were to happen, that's also going to make a significant difference to borrowers and their lending capacity. Again, any additional money made available to the market pushes prices up. So unemployment to rise, but unlikely to negatively impact housing values, basically because those that are employed are seeing real wage increases. Allegedly, there's a few arguments both here and there with regards to that. This one I think is interesting. Net overseas migration will continue to slow, taking some demand pressure off the rental market. So that's true. But I think the second part of that conversation is what impact is that going to have on the buying and selling market? Because typically what happens is when people migrate from overseas, they rent first for the first 18 months to 2 years, maybe even 3 years, and then they buy. They come in normally in Sydney or Melbourne, and then they figure out where they actually want to live. Do they want to live in Sydney, Melbourne? Do they want to migrate to Brisbane, Adelaide, Perth? And then they buy. Well, we are now coming up to that point where that initial wave of immigrants coming in after the borders were reopened, we are now reaching that point where that group of the market that were renters are now going to start moving into buyers. So that's going to mean some demand coming out of the rental market and it's going to flow into the buyer market. I would argue that this has already happened and is already happening, but we didn't just have one big wave of immigration came in. We had quite a lot over the first year or two after the borders reopened. So that is something that that population is now going to continue to push into the buyer market, which again places upward pressure. And I forget exactly where it is in this article, but it talks about pricing and the slowdown that was had middle of last year. But this is where this doesn't capture everything. This does not give you the full picture, because while CoreLogic is providing very relevant information, they are basing it on the data that they have, and that data lags. So there is what's currently happening in the market today that will show up in the data in months to come, and in some cases in years to come. And I'll give you an example which, as someone that does land developments and sells house and land packages, this is something that I see on the ground every day, is that I will sell, so I'll make the sale of land today, but that land may not be titled for 6 months or 12 months or 18 months. So that sale is not actually going to be recorded as a data point for 6, 12, 18 months. And once it settles, that's still going to take time for that data point to actually reach these reports. So the incredible sales that I was making in August last year, as an example, well, this report speaks of pricing starting to back off after July. Well, that's definitely not what I saw in terms of selling house and land packages in the north side of Brisbane. If anything, that was the biggest feeding frenzy I've ever seen. But again, those data points, that land won't be finished until middle of this year. So those data points will be reported in data very late this year or early next year. So this is when you're looking at getting into the market, these kinds of reports are very important, but then you also need to have a way of getting what is happening in the market today. And by far the easiest way to know what is happening in the market today and having that finger on the pulse is by being in the market yourself and actually transacting in the market. But when you're getting started, it's not so easy to achieve that. So that's where you need to build relationships with the people that are in the market, become parts of groups that are in the market, so you are getting finger on the pulse live data, what is happening right now. Because that makes a huge difference in terms of where you are offering, where you see value, and the differences can be quite staggering. They can be differences of 10, 20% or more in what a property might be worth when you are seeing that stuff happen on the ground, as opposed to waiting for the data 6, 9 months later, when that wave has already happened. You've missed the boat. And that's when it hits the media, and that's when everyone jumps in, but that's normally when the market is about to tip over. So if you relate to that experience of you have this experience in life where you keep getting in the market just before the market tips over, that's probably wise. You're not actually close enough. You are finding out about what's happening in the market way after it's actually happened. So really important, if you're serious about being in property and real estate investing, to find ways to get instant access to that data before it reaches these reports. This will give you a more holistic view of what's happening, but you need to have a much more micro view on where you are investing yourself. Residential construction remaining low, but cost pressures could stabilize. So this is another example of where the market is very segmented. You can't say that the market, well, I mean, you can say it, but it doesn't give the full picture. The market has gone up 10%. The market has gone up 5%. Well, which parts of the market? Because if they say that the market has gone up 10% in the past 12 months, as an example, well, I can tell you that the market up to 800,000 has gone up a lot more than 10%. But the market in the upper echelons, where there's less buyers at the moment because of affordability constraints, has potentially gone up much less. So what we are seeing at the moment, because there has been such a lag in new builds coming to the market, because there's been so much uncertainty around using builders, the market has shied away from building and selling. There just hasn't been a lot of that coming to the market in the middle ring sorts of suburbs. In the very affordable suburbs where the bulk of transactions are happening, yep, new land estates, all that sort of stuff, that's been happening. But in those sort of middle ring suburbs where you might be looking at knockdown rebuilds or 1 into 2 subdivisions or new townhouse setups and those sorts of things, there's been a significant reduction in the building activity in those areas over the past 2 years. So now the market is desperate for that stock, so is willing to pay a premium for that stock. There's a very big difference, very gap between what well-renovated stuff is selling for versus brand new stock. So again, this is where being on the market, finger on the pulse, being out there is so crucial, and not just sitting behind the screen looking at these reports. So again, very good information, and they're doing a good job of it. They're working with what they've got. It's your job as a sophisticated investor and as a professional investor, or even a novice investor, to find ways to fill that gap. And obviously watching videos like this is one of those examples. and relying on other resources that you've got. I hope that's been helpful. If you've got other questions, let me know. Probably the one thing that everyone's wondering about, interest rates. So look, in terms of the next interest rates movement, look, it seems to be a bit of a 50-50 split as to whether they're going to do an interest rate cut or whether they're not. So I would suggest that they're not, purely because if it's a 50-50 split and it could go either way, they tend to always err on the side of caution and be conservative, and they tend to hold on to rates a little bit too long before they make the move and then start making exaggerated moves, historically speaking. Now, that's not a given, but that would be the safest move for them to make in terms of their reputation. So my bet is that that's what they will do. So I think we will see some reductions this year, but I would be surprised. It's definitely possible, but I would be slightly surprised if it does happen with this in this first meeting. The inflation data is moving in the right direction, but there are still some stubborn bits that are kind of not moving the way or as fast as they would like. So I wouldn't be surprised if they wait a little bit longer to see that trimmed inflation rate come down below 3%. And that just gives them that confidence to move ahead. Again, I could be wrong. They might do it. But you'll notice I don't place a whole lot of emphasis on interest rates. And that is because if your strategy is so reliant on interest rates, then that's a danger in itself, because that's something you can't control. So look at strategies that enable you to add value, manufacture value, where you are not so reliant on interest rates. So if you bought a portfolio of properties that was neutral or slightly positive cash flow a few years ago, it's probably gone up wonderfully in equity, but you're now probably filling a gap, and that's a painful thing to go through. So that's an area where we need to start looking at, okay, is that really the right strategy for you long term? Because that can be painful, and the whole idea of investing is to improve the quality of your life long term. So if you're going through bouts of 5 years and 10 years where basically life sucks because you're trying to support all these properties, that's, I don't think that's the best way to be investing. Anyway, any questions, please pop it in the comments. Be very interested in your feedback and your questions and comments, and I'll see you soon.